So I'm not a lawyer, so I will be shorter than our previous speaker.
You don't charge per hour, right?
I will tell you first who I am and what my company is about, and then we will get into this very, very challenging topic, which is about funding innovation in Europe. So, just a very short biography. I'm an engineer by education. I started my career 26 years ago in the IT world. Worked for 13 years with Capgemini, so a group you may well know, and switched to the venture industry in '99. So I'm a venture capitalist since '99, 13 years. And the reason why I switched from engineering to venture capital was 3 years in the Silicon Valley, establishing Capgemini presence there. And '97, '99 was a very, very exciting period, probably the best period in the history of Silicon Valley, and I had the chance to discover internet, startups, VCs, and stuff like that. And I thought to myself, my professional life will be about that. So since then, I'm backing startups, and I worked for several funds, 2 French funds and 1 British fund called 3i. And in late 2009, I led and co-founded a new initiative called ISAI. I will tell you a little bit about that. ISAI is an interesting initiative because it's a VC fund that has been funded by entrepreneurs, basically for internet entrepreneurs, for French internet entrepreneurs that put money together and decided to set up a VC firm that will invest in the new generation of entrepreneurs. Basically, we manage now 2 funds. We have more than 70 million euros under management. 60% of the money we manage comes from successful entrepreneurs and 40% from institutions and corporates. And our 2 funds are targeted at 2 gaps in the funding chain. One is the very well-known gaps between angel money and VC money, because you can raise a few $100K from angels, but you need to get to a level where VCs will give you a few million. In between, there is a gap. And the second fund is about the gap that exists between private equity, local, small private equity guys and pan-European private equity firms. The local guys are generalists. They do small transactions, but they don't know about the technology. And the pan-European guys knows about technology, but they don't do small transactions. So what if you are an entrepreneur wants to raise 3 million or 4 million in a private equity transaction, and the local guy doesn't know about your business, and the guy based in London doesn't care about small transactions. Before getting into the topic, I want to be very clear about the way I look at this innovation funding stuff, because there are many ways to look at it, and it really depends who you are. So first, I'm a VC. So for me, funding innovation means looking at projects that are backed first by angel, then by VCs, then by private equities. There is a way to fund innovation, but the way I look at it is this, because that's probably the most credible, the most reputable way to fund innovation that exists so far. Second thing, I'm a software and digital media or internet investor. So I look at what is happening for the last 15 years in the software and internet industry. Obviously, biotech, medtech, cleantech, semiconductor, and so on could have different funding requirements and different, I would say, issues to face. And third thing, I'm a startup guy. So I think that innovation comes only from startups. There must be some innovation coming out of universities or coming out of large corporates, but seen by me, it's only incremental and defensive. It's not real innovation. Again, that's a personal mindset, but I wanted to put that before telling anything about our business and the venture capital business as it is. The venture capital business and governments or politicians are somehow surprisingly aligned, because the venture capital is today one of the levers that allow economical development, that allow growth in a continent that is seeking desperately for growth. I have here a very small association. It's an association I have funded called France Digital. It's 12 VC firms and 108 startups. And we have collected all the data about the startups that we have funded, and we have looked at the cumulative or aggregated data that we can get out of that. So you can see that, in average, these companies are 7-year-old. So they are not, brand new startups, 7-year-old in average. In average, they received 7.7 million euro of funding each, angel money and VC money. And their cumulated revenue in 2011 is 1 billion. So it's, we are a big company with 108 startups. And last year, in 2010, the year earlier, we were doing only 750 million euros. So it means that this big company, virtual big company, is growing by 33%. And again, it's not a small number. 1 billion euro is a big number. This group of companies is doing 39% outside of France. So they are exporting more than large French companies. 40% is a lot. They are doing only 11% in the EU outside of France. That's interesting. So it means that if you are a French startup, you will go to the US or you will go to Asia, and you will skip Germany or UK. The cumulative payroll of this 108 company is, 5,400 people. Last year it was 4,300 people or 4,400 people, so it's plus 24%. And the R&D space growth rate is higher than the revenue growth rate, 34%. People in the company are relatively young, 32-year-old. Management are not people just graduated from universities. In average, they are 32-year-old. Permanent contract, 87% of the employees. So it means it's not insecure, part-time, blah, blah, blah jobs. They are real jobs. And the social environment within the company should not be that bad, because the average salary of officers is only 2.6 times the average salary of employees. I think in large companies it's a bit more than that. And 83% of these companies are offering participation to equity value creation to their employees. So this business is about making money, and my goal when I invest in a business is to make money, but having this role allow as well some very socially responsible economical development, and I wanted to highlight that. The traditional VC game is a strange game. Some of my friends at Quilvest is a famous private banking / family office firm in Paris. I've made a study about 25,000 startups that were financed between 2000 and 2010 by VCs. And you have to know that probably 1 out of 10 or 1 out of 20, I will say, funded startups, well, not funded, let's say created startups, are funded by VCs. So it means that they have made a survey representing something like 250,000 or 500,000 startups that were created. Then 25,000 were funded by VCs, and then they look at what is happening after that. Out of these 25,000 startups, 6,400 were exited, meaning they were either sold or they IPO'd, okay? Out of this 6,400, close to 1,000 were winners, meaning that their value was more than $100 million, and obviously investors made money out of this exit. So it means that if you raise money from VC, the chance for you to be the CEO of a company valued at more than $100 million is 1 out of 26. And out of these 25,000 startups, only 35 became billion-dollar companies. So it means 1 chance out of 700. Okay? But what is interesting is the value creation. The 980 plus 35, roughly 1,000 out of 25,000, so roughly 4% of the companies created 77% of the value. And all the rest, the 96% all other startups, just created 23% of the value. So the VC game is by definition absolutely unpredictable. The concentration of profit makes it absolutely unpredictable. What is for sure is that the majority of investments that are made by VC are unprofitable. And if you are a lucky guy, you have a winner. If you are a very lucky guy, you have a super winner, the billion-dollar guys. But you know, that's basically how the VC world is functioning. If you try to benchmark what is happening in the US and what is happening in Europe, there are some interesting figures on this tab. First thing, the VC business, early stage VC business in the US represents more than 0.1% of GDP. In Europe, it's 0.02. Okay, so you spend 5 times more money in the US in the VC business. I will skip the number of funds. If you look at the number of deals in 1 year, and I took 2010, the number of deals below $5 million are quite similar. You know, 1,279 in the US, 700 in Europe. It's not, you know, we are not that far away. But if you look at large deals, more than $5 million, it's 1,000 in the US, it's only 200 in Europe. If you look at the probability to have a $100 million plus exit, I told you earlier that in average it's 1 out of 26 globally. It's 1 out of 20 in the US, it's 1 out of 80 in Europe. Good news, if you look at the value, the money that has been injected in companies that are valued at exit more than $100 million, the US companies have raised 79 million, the European companies 44 million. So it means that you create winners, less winners, but with less money in Europe. If you look at the VC firms that went out of business from 1999 to 2009, only 15% of VC firms got out of business. 57% of VC businesses in France went out of business. And the reason why is that in the late 90s, a lot of people launched VC firms. Then you got the internal bubble. Then you got the bubble burst. And after that, people were at their first fund. They had no experience, no track record. Nobody wanted to give them some money. And so they went out of business. If you look in 1 year about the value of VC investment, the US represents 82% compared to 18% in Europe, so they invest much more than we do. But if you look at the number of cases where investors get 10 times their money back, 36% of the cases are in Europe. So again, we invest less money, but we make better multiple because we create smaller companies with less money. So that's basically the benchmark that you could wrap up regarding US and Europe. But the big difference between the two continents is that the VC business is a 50-year-old business in the US, and it really started in the mid-90s in Europe. So it's only, you know, less than 20-year-old business in Europe. If you look now at geographical split, and that's a big issue for Europe, not to be a market, and only one market, I would say. That's multiple market. It's interesting to see. I'm sorry, I've got no separated figures for Switzerland, so you are with the Germans. You are on this slide, you can see where the money is invested in Europe. And you can see that the three big geographies are UK, France, and Germany, Austria, Switzerland. And you can see as well where the money comes from. And it's interesting to see that UK represents roughly 20% of the money as far as destination is concerned, but 32% of the money as far as origin is concerned. So it means that the VCs based in London are basically the pan-European VCs, and they invest in France, they invest in Switzerland, they invest in Germany, they invest in the Nordic. Critical mass is a big issue. Silicon Valley is by definition the cluster that exists on Earth. One could say that London, Paris, and Berlin, or even Stockholm, have reached some kind of critical mass, but nothing to do with Silicon Valley. To compare, Silicon Valley is about 10 billion per year, and the biggest geography here is less than 1 billion per year, and it's Germany, Austria, and Switzerland all together. This slide is really scary. It shows how much money has been deployed by VCs during the last 5 years, and how many has been raised by VC from LPs to invest in companies. You can see that 2007, it was very, very fine, because you had 6 billion deployed by European VC, but these guys were raised 8 billion. So it means that, backlog of cash that could be deployed into new companies, new or existing portfolio. 2008, it was even at 6 million, and then you got the financial crisis. Level of investment decreased to 4 billion, and level of raised capital decreased to 3 billion. And we have 3 years in a row where VCs are deploying more money than they raised. So it means that that won't last, okay? Because LPs would commit money for 5 to 10 years, but it's a rolling mechanism. So it means that if the fundraising red bar does not go up, by definition, investment will go down dramatically. It has to be noticed as well that in 2008, you can see that the number of deals per year is still, between 3,000 and 4,000, and did not decrease that much. What really did decrease is investment in very capital-intensive sectors, such as telecom, semiconductor, and things like that. It almost stopped. So, the Series A with $15 million to build something in the telecom space, you don't see any anymore. There is no more deals like that since 2008. After bad news, I've got good news. The entrepreneurial pool in Europe is really, really interesting and growing. First being a large community of entrepreneurs with some experience and some track record has been built during the last 15 years. And these guys now, they either invest, and that's what my LPs do. They invest in my fund, they invest as angels, or they launch new businesses. So these people with experience and risk-taking ability are now available. They were basically 30 in the late 90s. They are now 40 or 45, but they exist and they did not exist earlier. Second thing, the latent entrepreneurs, meaning people that are wannabe entrepreneurs. If you make a survey in Europe, during the last 5 years, it went from 5% to 7.4%. In the US, surprisingly, it went from 10% to 7%. So it means that today, if you make a survey in Europe, you will find more wannabe entrepreneurs than in the US. That's very, very, very good sign. And in VC portfolio, if you compare vintage 2000 and current vintages, so 2010, 2009, you had only 8% of repeat entrepreneurs that were leading portfolio companies in 2000. Today it's 40%. So it means that the guy who is running his second business, his second company, second venture, has much more chance to succeed than the guy who is a first-time entrepreneur that will make all the mistake and discover at the end that his business is a failure. And last but not least, and I think you would agree with that, in business schools, the entrepreneurs program now are more popular or more prestigious than the finance ones, which is obviously a surprise for people having graduated in the late 80s like me, but that's becoming true. It's better to do an entrepreneurs program than a finance one at the business school. There is a trend as well which is very interesting, quite new and very specific to the internet space. It's all about accelerators, super angels, micro VCs. There are plenty of them. All of these players are European players, and I'm sure I could find probably 100. It's only, you know, the most well-known that I have put here. They have different models, and I will describe them in a few words. An accelerator is more like I give you very, very little money, like 10,000 euros, but I spend a lot of time with you to help you to define your plan, to design your product, design your go-to-market strategy, blah, 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 blah. I help you to prepare the equity story that you are building. So it's an accelerator. So they don't take too many companies, they don't put that much money, but they work a lot. Then you have the super angels. They do the opposite. They invest little money, let's say 10K to 100K, in plenty of companies because they have some kind of probabilistic view that they might be a super winner in their portfolio. And because they are invested in 100 companies, they can't support them, so they do nothing. Okay? So that's super angel. And you have the micro VC, and my company is a micro VC. You do not that many deals, but you put much more money, like 1 million or a bit more than 1 million. And in that case, because you have a small portfolio, you are very hands-on and very active to support your portfolio. But all of these initiatives, most of them have been launched by entrepreneurs, former entrepreneurs. And what is interesting is that launching an internet business nowadays is much less than 1% of what was needed in 1999 to launch the same business. So it means that today, early stage internet startup funding is not an issue. The big issue is what's next. So launching a business doesn't cost that much. Funding initial seed capital is not difficult, but what is necessary to get to the next step, and that's where the bottleneck starts. About the funding chain, again, the VC business is about managing the money of third parties, putting it at work into companies, and then returning back the cash to the people who have delegated the money, and we call these people the LPs, limited partners. The regulation, Solvency II and Basel III is a catastrophe for the industry. So it means today, no bank, no insurance company can reasonably invest significant amount of money in venture. They were, in Europe, the main LPs of the industry. So these two regulations are killing, absolutely, the industry. We have other weaknesses in France and Europe, and some countries in Europe. We have no pension fund because the retirement scheme is not based on capitalization, but more on using the money of people working to pay the retirement of people having stopped working. So no pension fund and no university endowment or very small ones. If you look at Stanford or Harvard or MIT, they have billions of dollars that they invest in venture capital. So it means that today, the VC industry in Europe is mainly supported by government agency or European agency, and I've mentioned here European Investment Fund that you may know, that is a big LP in all the EU countries, or in France we have a Caisse des Dépôts that is well known. All these guys were supposed to be seed players or top-up players originally, meaning, a new firm, you want to raise 25 million, you find 15, we give you 5, and maybe with the 20 you can find the missing 5. Now they represent more than 50% of the money. I think there is an EU threshold at 50 for all government money, but basically they represent at least 50%. Again, the tax cut, tax credit-based funding is very, very important. For angel money, you have a tax cut on wealth tax in France called TEPA. You have a tax cut on income tax in the UK called EIS. You have vehicles that are funds gathering individual people money that give taxpayers with a tax credit, like FCPI in France or ACTs in the UK. This represents roughly, as well, half of the business, of the VC business in Europe. So it means that today venture business and economical policy are somehow linked together. And the way they look at things is very different, but without public money, there won't be any venture funding in Europe. Obviously, family offices, successful entrepreneurs, high net worth individuals are participating to the game. They consider that it's interesting, but by definition, you don't raise a $1 billion fund from family office and successful entrepreneurs. So it means that it leads to small initiatives like mine. ISAI is a small initiative. We have 70 million euro in 2 funds, so it's 2 very small funds. But we have these guys behind us. The only good news, but it's a relative good news, is that the venture piece in the private equity cake has become bigger because the cake has shrunk a lot. So venture was at 5% in 2008, and now it's 17%. What has disappeared is about debt, financial leverage, financial debt leverage, so LBOs and stuff like that, and big LBOs that have entirely disappeared since the financial crisis. Today, not today, but for the last, since 2007 or something like that, we are in a situation where the demand for capital and the supply of capital have crossed. After the bubble burst in 2000, there were plenty of money available, plenty of money that was committed, and a lot of entrepreneurs will get back to consulting or to banking. So basically, more money than valuable businesses. Today, you have plenty of companies that are launched because of seed money is available, accelerators are available, super angels are available, plenty of small companies, and the traditional LPs, such as banks and insurance companies that have disappeared or stopped putting money in the game. So it means that there is clearly a big gap between supply and demand. If you're an investor, it's a good time to invest because by definition you will be in a good shape to negotiate because there are plenty of people willing some money, you have money, so you are the king. You are the king, but what about further funding? What about the next round? Will there be some people ready to syndicate with you the next round and partner with you and put some additional money into the business? You are not sure. So because you are not sure, you are very conservative, very cautious, and basically it means that you invest only in businesses where the capital needs are reasonable or progressive, and you have no appetite for a capital-intensive venture. That explains, again, the drop between 2007 and 2008 and 2009. All this capital-intensive venture funding has disappeared. If you look at exit liquidity, because if you want the VC game to work, you need to pull the money at work, but you need to give the money back to the LPs in order for them to put the money into the game. There are big differences between the US and Europe again. It's quite impossible, and we were talking about that during lunch, quite impossible to sell a feature company in Europe because there is no buyer. If you are Silicon Valley and you develop a small app that do something with pictures and blah, 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 and blah, 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 maybe you will sell it to Twitter or to Facebook or to Google for some stocks or a few $1 million because these guys, they buy technology. If you do the same in Europe, there are no buyers. absolutely no buyers of technology. In the internet space, the only buyer that really is active is a German media group, Axel Springer, and they don't buy technology, they buy content. So if you develop a feature company and a technology play in Europe, if you have no business model, you won't get funded because VCs know that they can't sell the technology for the technology. The small cap capital markets like AIM in London or Alternex in Paris are dead ends. You know, you can raise money on this market, but you can't get liquidity out of the market because there is no liquidity. So it means that it's a trap for shareholders. And again, the EU trade buyers, there are not that many, and they have unattractive multiples. So it means on the European stock markets, they don't pay the right price. So it means that the only way to go is to build a European business and sell it to a non-European player, which is, you know, a bit depressing. It's not that bad because the money that shareholders will get back into the European economy and so on. But because there is no real cluster, because there is no real critical mass of acquired company, American companies, for example, will relocate R&D to the US, and you know what has been built in Europe will disappear. The only exception to that is Israel. Israel has an R&D center for Cisco, Google, Intel, Microsoft, because they sold a lot of small companies to them, and these guys have now R&D centers in the country. But when Google just made its first acquisition in France last week or in the last month, and basically they relocated a small team in Mountain View because they say we have nothing in France, so you have to come to Mountain View. A good news, the private equity guys, the guys that were doing LBOs, so financial leverage transaction, now they recognize that they can't do debt, so they do growth, and what is about growth is about technology or about internet or stuff like that. So an alternate way to find liquidity for entrepreneurs and shareholders is private equity through a transaction that are buyouts, but are not based on debt, are based on growth. So if I wrap up, the venture capital ecosystem in Europe has learned and improved a lot for the last 10 to 15 years. The entrepreneurial pool and mindset is now very pregnant in Europe. That's very good news. The market is obviously very fragmented, and there is no real critical mass per geography, per sector. The only exception being, you know, maybe London and internet, Paris and internet, Berlin and internet, but that's the only real critical mass that has been achieved. The US and especially Silicon Valley is still an undisputed leader in this because they have the big late stage investment capability that do not exist in Europe, and because they have these multi-billion dollars IPOs, like, even if they are crap IPOs like Facebook, you know, it's $10 billion that has been raised in one day by Facebook. Maybe the investor that put the money were basically screwed, but it's $10 billion that goes to the entrepreneurial and VC ecosystem. And despite all this progress, and because of regulation, a lot of LPs and especially banks and insurance companies have pulled back from the asset class. Ironically, it's perfect time to invest, but nobody wants to invest. And to finish with an optimistic point of view, I put, I think, 33 logos on this slide. All these guys are Europeans. Some are actual successes. Some are potential successes. None of them are copycats. It's things that have been invented in Europe. It's not like I do the same thing that the guys do in San Francisco and I will replicate the stuff. So if you look at things at the continent level, and if you look at things focusing on software and digital media, Europe has reached critical mass and has built very nice companies. Thank you, and I'm ready for your question.